think it signals to the market that we're on the, bottom, back end rather of what we just went through. We still may go through a recession, economic recession, but we're in a real estate recession right now. We have been for the last 2 years, and I think we're getting closer to coming out of it. So we're super psyched about the future.
Hey everyone, thanks for listening to another episode of Buildings 2.0. Today, I'm speaking with Frank Forte, Managing Partner, Lucern Capital Partners. Frank, thanks for chatting with me today.
Yeah, thanks for having me, Jose.
Take us back. So before real estate, you were in investment banking, and before that, you were just a kid. And I think in New Jersey. Tell us more.
I started my career following the financial crisis, right? So initially, I always wanted to be a finance guy, but more Wall Street, right? I always wanted to be a stock or options guy, trader. I have a high aptitude for math, so always kind of wanted to do something exciting, fast-paced. For those of you who know me, Jose included, I'm a very fast-paced person, so that sort of stuff was always very exciting to me. And moving quick, making deals, making trades. Unfortunately, when I graduated, we hit the depths of the recession right after 08. So kind of real estate was always my second love. It's always something I actually saw myself doing later on in my life after I had made money, hopefully doing something else, right? So, I started my first gig was actually with, you couldn't find jobs then, right? Especially in finance. So my first job was actually with, I was a consultant for the US Treasury, and I was taking banks that had failed and I was merging them together. And it was super interesting, very rewarding. Pay was not great, as you could imagine. And it took me all over the country, right? So I was going to these really small community banks that were in the middle of nowhere, literally, and taking them, merging them together and figuring out what was wrong with them, trying to bring some up to health, some of them sadly closing down. Really interesting, right? And you see all walks of life and kind of understand different banks and, what important piece they play in their community, right? Like we would look at agricultural banks that would, lend to these people's farms and all this interesting stuff. So I left there and I got a job back in New Jersey because I was traveling a lot on that job. I was traveling probably 50 out of 52 weeks of the year. Crazy. It was really intense. So I got a job in New Jersey, coincidentally, not far from where our office is now, and we were doing senior housing. So we're buying and selling senior housing facilities, Alzheimer's, dementia, you name it. We did some drug and alcohol rehab, some other private pay stuff. And we were both investing and we were lending money to operators. So it was both private equity and private debt. So I did that for a while. It sort of satiated my need short term for real estate, but it wasn't the real estate I wanted, right? I wanted to be sort of a generalist, understand everything. This was very niche, very kind of pigeonholed. And so I left after a few years and I went to go work in Manhattan for it was a jointly funded entity, kind of secretive when I took the job and ended up figuring out what it was after. But it was a small distressed asset management team for the largest CMBS default that ever occurred in the history of the world still, which was the Peter Cooper Village Stuyvesant town deal. So in '06, MetLife sold PCBST, as it was known, for $5.6 billion to a consortium of people, Church of England, Singaporean Investment Bank, the Vatican. There was 20,000 creditors. And who bought it, right? It was Tishman Speyer and a bunch of other folks, but Tishman Speyer was the sponsor. So Tishman Speyer and BlackRock thought they would triple the rents, over the course of X amount of years. They didn't. There was all these rent protections that they, thought they were going to subvert. Definitely not the right word, but they thought they could raise the rents much quicker than they did. There's a book called Other People's Money on it, if you want to dig in deeper, that talks about the whole deal. So long story short, it went belly up. And when a deal of that size goes belly up, where there's 20,000 creditors, there's something called a special servicer. And they're the ones who get the keys handed back to them, right? And they represent all of the creditors and the bondholders to try to recover their money. So I was hired by a joint venture group of the special servicer and another large investor to help kind of rehabilitate this asset, along with several other people, back to health. It was a consultancy sort of position before it was sold. So I was there for about 2 years. It was super interesting. PCVST, for those people who don't know, it's a whole corner of Manhattan, right? There's 8 zip codes. There's 25,000 people, almost 12,000 apartment units. It's the largest single campus housing property in the world, apartment property in the world. Super fascinating, learned a lot. At this point, I was living and working in the city. Naturally, we were living in Brooklyn. And, we ended up selling the deal to Blackstone, right? For about, $5.4 billion. And I left. I was a junior guy at the time, got paid decent, but definitely didn't reap the full rewards of that deal. And I took a job in banking. And I was a banker. We were doing about $1 billion to $2 billion a year out of the New York office where I was working, which was the headquarters of a large company called Berkadia. It's owned by Warren Buffett and Lucadia. It was a joint venture, and we were doing all sorts of financing, apartment product, office, industrial, whatever, what have you. We were a small team, about 12 people, so got a lot of deal experience, a lot of reps, and I sort of had this well-rounded thing at this point, right? So I sort of sat on all sides of the table. I was the guy mopping up right after the financial crisis. I was the guy financing stuff. I was the guy doing asset management. So I'd sort of seen it all and always wanted to do my own thing, just never knew what that would be. And at some point, I started to realize the only guys that were making more money than the bankers were the guys actually owning the real estate, right, and investing the principals. So I left and I met two guys. I started a business called Lucern Capital Partners, which we have now, which next month will be about 8 years old, which is
Wow.
exciting. And thank you. And the mandate really early on was to go out, buy apartment product that had been beat up, mismanaged, was behind the market, capital star, fix it, turn it around, and sell it for a profit. And for people in our space, they know the last few years the apartment market was on fire. We were in it early, right? This was 2016, and so we got in early. We started investing in New Jersey. We started investing in Philadelphia. Initially it was areas that were close to where we lived, right? Because we could access the properties quickly, and Jose, and too as a real estate investor, you want to be able to touch the assets, right? And it's important to be close to them. And at the same time, we started investing in North Carolina and Charlotte because it was an hour and 15-minute flight away. So although not driving distance, it was super close. You could get there. It's a hub for American Airlines, right? So there's a lot of air traffic, and it was a growing city. So fast forward, we have very little holdings in New Jersey now, very little to no holdings in Philadelphia, and then we have a lot down in the Carolinas, which has become like a base for us, and we rode that growth up. So at this point, we've done close to about 300 million of volume transactions over the last 8 years. We've raised probably about 80 million of private capital during that time to fund those deals alongside of our own money, of course. And about 2 years ago, so we made a good bit of money. Like 2 years were tough, right? Transactional volume was low, the market was crappy, interest rates were up, a lot of uncertainty. What's going to happen with the economy? Now you have the uncertainty, leading up to the election of what's going to happen there and how is that going to impact, the marketplace. But about 2 years ago, we started to move away from apartment product. We saw the writing on the wall, right? It was getting very overbuilt, very difficult to get people out post-COVID. A lot of the restrictions and the eviction moratoriums went on, honestly, for way too long. And it hurt a lot of people in our, people don't realize, right? They think landlords are just, a bunch of, fat, rich cat type stuff. And it's really not true. I mean, real estate is a very thin margin business. And when you have something like Beacon that goes out to the market that says, hey, you don't really need to pay your rent because we're not going to let you out because you can claim a COVID exemption or whatever, it has these ripple effects and it changes the psyche of a renter and their willingness and ability to pay. So you had widespread fraud, application fraud, eviction fraud, all this stuff. And anyway, the business became very difficult. And we saw the writing on the wall. Rent growth was starting to slow. You had increasing insurance costs, increasing payroll costs. It's difficult to actually manage the assets. Property management became difficult. And we said that we want to start to get out of this and, find a new asset class to start investing in. During this time on the side, we were building a warehouse project that IPX actually surveyed, right, in Howell, New Jersey, where you've been. And we bought the land, unfortunately, from someone who had passed away. The project was partially, worked on, and we finished it. And it was a multi-tenant warehouse, it's about 35,000 feet. And we ended up doing really well in the deal. We still own it today. And we looked at this and we said, this makes a lot of sense. There's these smaller warehouse units that people need, right? Tradesmen need, HVAC guys, pest control guys, mold remediation guys that sell stuff on Amazon, whatever it may be. And you really can't build it, right? We built that project because we got it at a special basis, but you really can't build this stuff because economically it makes sense to build the larger warehouse product, right? What's called the bombers, the stuff you see on the side of I-95, right? The huge, logistics facilities. So the stuff is in high demand. You can't build it. Even if you could find the land, it's tough to get the zoning. And we said, hey, there's this interesting little niche where there are these small business marquee type properties that are overlooked. You can buy them sub, 10 million sub institutional grade for the most part. and they have a lot of torque in the rents, and there's a lot of value. And, by the way, the tenants don't look at the rent per square foot like they do in a large facility. They just say, Jose, Frank, what are you paying me per month? What do I have to pay? What do I get? And when can I move in?
Yeah.
So it reminded me a lot of the workforce product we had seen in multi in the early days in 2016. The sub $10 million product. It was mom and pop owned. It was fractured ownership, horrendously mismanaged, and there was a lot of juice. So we started buying those about 2 years ago, and we've done really well. We're adding to our portfolio, and that's kind of the way we've taken our company in the last 2 years towards this what's known in our industry as small and shallow bay light industrial product.
Yeah.
Heavy industrial is like when you see big like plants and stuff like that. Most people that invest in industrial real estate do not invest in things like that. They invest in what's known as light industrial, or like 3PL and logistics. So kind of a crazy path to get to where we are, but this is going to be that next gen of our company. And a lot of why it's interesting to me is one, like I said, there's these amazing supply demand imbalance, right? That you could take advantage of, but it's really sad. I think real estate is a people business, and I think post COVID, you've seen this kind of shift where a lot of people that were in that industry, specifically on the property management, right? The people that keep your property humming and moving like a well-oiled machine, similar to hospitality, you saw a lot of those people leave that space, right? The older people were just like, I'm done. Like, I'm fed up with this. COVID happened. I'm not going back. And it's really difficult in today's world to find good labor, right? It's really challenging. And you see it in construction, you see it in any service-based business. Finding people who care about their job and want to work and have pride in work and a work ethic, it's tough. And those property management jobs are tough, right? You have tenants coming in, they're constantly complaining, you don't get praised. It's a difficult industry to work in. And I think, outside of the, proliferation, right, of AI, that's going to take some of that stuff over. You already see it happening in multi with virtual leasing agents and these people that you can, use large language model to interact with you. They almost sound like real people on the phone. You're going to see people at the property level replaced by these technologies because operators have begun to realize it gets really hard to find good people. They're expensive. And even then, they know they're in short supply. So you're not getting the productivity out of them that you would like. So what's easier, right? Let's replace them with AI. And for smaller operators, that's increasingly difficult to do. It's expensive, these systems. They're unwieldy. All of them have overlap, right? So you have all these things you're paying for. I think you're going to see a lot of the large operators, the ones that own tens of thousands of units, they're going to succeed and do really well in that space, right? And they're going to be the early adopters of the technology, and they're going to be able to actually meaningfully cut payroll and costs. The smaller ones aren't. So bring this back to industrial. We're leasing to businesses, right? Other business people. This is not their home. This is their livelihood, right? So they come, they pay the rent, they work hard. You don't need a property manager. You don't need on-site presence. It's a lower reliance on human capital. And among all these other facets that have made us really interested in the space, that is just a supporting cast member to that, where it's like, hey, we're not going to also have the staff problems we've had over the last few years and, escalating payroll costs. So it's really interesting. We're super psyched about it. Super psyched about next leg up. We saw basically 225 basis point cuts yesterday in the form of a 150 bip cut. So that's really exciting. I think it signals to the market that we're on the bottom, back end rather of what we just went through. We still may go through a recession, economic recession, but we're in a real estate recession right now. We have been for the last 2 years, and I think we're getting closer to coming out of it. So we're super psyched about the future. And yeah, hopefully that was I know it was kind of a little crazy, but wanted to sort of tell you how I got to where I am today.
Yeah, super exciting. I think the landscape of subjects you touched on is like wide ranging from your experience from consulting in the treasury, investment banking. You worked on a few multi-billion-dollar deals. Now you went from the lending side to now the ownership side. So a lot there. Actually, if you had to summarize to like a young Frank, what are some of the kind of gold nuggets that perhaps you learned that might go against conventional wisdom that now inform the way that you think about acquiring and managing properties today? Like what are certain things that you learned along that journey that you'd say like, are up on your wall?
I'll give you a couple that are not against conventional wisdom, but are important to repeat, right? Hard work is everything. This is what I tell, I mentor. I went to Seton Hall, right? So I mentor kids. Sometimes, we have this program, and every couple of years I participate in it, depending on, my schedule and availability, whatever. And I always tell these guys, I'm like, look, the value of hard work cannot be underestimated. Like hard work is everything. If you put your head down and you grind, no matter where you are, if you're on, you know, rung 0 and you want to get to 20 or 10 and you want to get to, it doesn't matter where you are. Hard work will always pay off. It may not be tomorrow, it may not be the next day. You may have to wait longer than other people, but if you put your head down and you work hard and you take the right opportunities, right, you will invariably succeed. It's just a matter of when, right? And for some people, like I said, it happens sooner. So hard work is super important. Second thing is I'm a very extroverted person, right? Net, it has definitely paid off for me. I could be intense in certain respects. I'm very extroverted. I'll talk to anybody. You never know who you're going to meet. You need to meet and network with everybody. It doesn't matter if you're at the airport, you're talking to some random person, you get in a conversation with someone and you build these connections, and it has paid off so much for me over time because you don't know, like there's like a guy in the gym, for example, you always see, in a class or something like that. And you guys work out together or someone and you start BSing, and before you know it, you find out you have a ton in common, right? So you always need to find commonality with whoever you talk to and find common threads, and those lead to relationships, right? And it could be anyone you meet anywhere. You never know who you're going to meet, and those opportunities are fleeting, right? You're in maybe the same room with someone, or you're next to someone on an airplane or something that you'll never be in that exact same position again, right? The universe, put you two together, just it's intermittent crossing of paths, right? And you need to seize those opportunities because they pay off and they could be really valuable, and it could change your life. So those are the two wisdom points. You need to talk to everyone. You need to network. You need to put your head down and work hard. I think you need to be a decent person too. Real estate is littered with bad people, right? This is one of those industries that attracts very, seedy sort of people. My advice to these, like the younger guys that work for me too, I'm like, look, if you're a decent person, you do the right thing, and you have morals and ethics, you've already beaten half of the people out there, right? So it's an easy way to get ahead of more than 50% of people. Relationships matter, and doing the right thing matters. Screwing people over, burning every bridge, you're not going to last long. And real estate's a marathon, right? It's not a sprint. So I think I would tell young Frank to focus, I think, on the journey, right? And less of where you think you're going to end up. If you love what you do, and you do what I said, you work really hard and whatever, I think the money is always going to come, right? One of the important things for young people is they perseverate so heavily on their starting salaries when they get these jobs, right? Oh, this job's going to pay me whatever, 80. This job's going to pay me 65. I need to make $15,000 more. Well, you may not realize that 65K job might speak more to who you are, or it may give you a better path. And I don't think people consider that, right? They say they do. Young kids say, oh, well, it's about the fit, and they use all this, mumbo jumbo to this. But at the end of the day, young people's psyche is very in tune to how much money they think they want to make, or they think they deserve. And it's hard, right? You go from making 0 as a college kid to all of a sudden you're making more money than you ever made in your life, even if it's not a lot of money, right? So it's a hard thing to reconcile, but one of the greatest lessons I ever got. So when I got that job as a banker for Arcadia, I had turned down another job for large private equity company, and they were buying fractional interest in trophy assets across the globe, and they were amassing them, and they would get enough board control to basically flip the assets. So they buy the positions at illiquidity discounts, right? And then they would amass a bunch of them. Then they would flip control of it, and they would sell the asset. And they would make a lot of money. And most skyscrapers and big assets across the world are actually fractionally owned by different investors because they're unwieldy, they're large assets. So this was the strategy. The guy that ran it was very, very intelligent, super successful, just really extravagantly wealthy, and just like, brimming with energy, right? But I turned it down, and I took the job at Berkadia because the guy who I knew said, hey, Frank, you're going to make less than what you'll make over there in the beginning. But if you work hard, there's no limit to what you can make here. You could be 30, make $1 million a year. There's plenty of guys here that do it. And the other job was pretty nice salary, right, and bonus. So I was going to have a lot of like current income, but I chose that path, and he was right, right, and I did really well.
One of the things that stands out to me about your journey is that, as you've mentioned, working hard is kind of the table stakes. But in that journey, you've also outlined that kind of in every step, you've been able to absorb just more risk, right? Versus a consultant, lender. Now you're the owner. Talk to me a little bit about that, because I think that that also has to do with just kind of the level of both upside, but also downside that you face in kind of each role. Today, when you're looking at a new acquisition. Talk to me about your playbook. How do you think about risk? Who's on your
Sure.
speed dial? And just walk me through like what's a successful acquisition and repositioning.
Listen, there's the old adage, right? If you don't know what you don't know, you find someone who does, right? And that's where we talk about relationships and having a wide network. So I'm gonna walk you through an acquisition we're working on right now. It's in a new market for us, right? I won't be super specific, but it's in Maryland, right? It's a DC metro property. It's not a market we own in currently, but a market we've wanted to be in for a while because it's dense. It has all the attributes. We don't have to go into it that we think, we were discussing earlier, why we think makes a good investment. Supply, demand, tough to build, all that stuff. So it's a new market for us. And, a new market doesn't come with just going online, right, and reading research reports and understanding, oh, the vacancy rate here, the rental rates are here, blah, blah, blah. You need to understand, like, who is going to be my team, right, when I buy this asset? Who's going to be my attorney that's going to represent us in tenant and landlord matters if we need it? Who are going to be maintenance people or vendors that we're going to use? You look at a market like Charlotte, we've been there for 8 years. I have a million people I can call, right? I our team knows who it is. Oh, it's this person, this problem, call this guy, right? And it's easy. So when we look at a new opportunity, we try to absorb everything we can and we try to diligence it from every angle. So this opportunity particularly, I knew it was coming to market a few months before it did. So I told the folks that were selling it, I said, look, I'm going to go do a bunch of upfront diligence. I don't care if you decide to sell it to me or not, but I'm going to do all this stuff up front to show you and prove to you that I want to own this asset and that we want to be in this market. And I did, right? So I spent several times trips going down there. So, but I don't know anyone down there, right? I didn't. So you're starting from square zero. No, you know nothing. You don't even know where to begin. So what do? I start reaching out to my network to find people I know who do business in Maryland. And then I talk to those people, right? And then I get introductions to other people. And then I talk to those people. And I said, well, who's your guy? Like, there's always a go-to guy, right? That's what you have to realize. In every market, there's a go-to guy for one thing. Who's the go-to eviction attorney outside of DC? And I ask three people, I get the same name, right? So I set up a call with that guy. Now that guy's on my team, right? And you go through this process with each rung of your acquisition. And the more people you know and the more solidified pieces of the puzzle you have, the lower the overall execution risk. You still have to do it, right? And get up there and roll your sleeves up and make it happen. But you at least have the right players. That's step one. So you get the right players on your team.
Yeah.
How do you find an attorney, for example? You call around, you find the top shops. I'm willing to pay up a little bit because I want the best attorney right now because it's a new market for us. So I can't afford to F it up, right? So
Yeah.
I need to find the best people in that space. So you go and you assemble your team. That's step one. Step two is, diligence can't be understated. Like you want to turn over every rock. Asking more questions is better than none. We go through every lease with a fine tooth comb. We do lease abstracts. We inspect. We've been to the building 4 times already. We're still in due diligence, right? We've been up on the roof. We take drone photos. We go in. We talk to the tenants. I mean, we go so deep. We go into easements. We do full historical Oprah requests. See what's going on at the property, permitting, C of O, all of this, and we dig in super deep. And our team is super focused on it. You usually only have about 30 days for diligence. The benefit here was I convinced these people to give me a lot of this information several months early so that I could be prepared so that when it came time to bid on the property, I could bid and be as competitive as possible. So I spent an extended amount of time, probably 3 times what we normally spend diligencing on this asset because it was a new market and I had to get there. So you go and, the most important thing is preservation of capital, right? So you want to make sure your leverage is appropriate, your financing is appropriate, and you want to look at worst case scenarios. You want to sensitize it and beat the hell out of the deal. And if it still works when you do that, even if it's not the returns you expected, but it still works, that's a deal probably worth doing.
And what are some of those levers when you say kind of like beat down the property, assume the worst? What
Yeah, so like
some of the levers you're thinking about?
yeah, it's like I'll give you an example. This deal, the average rent is in the mid 11s, triple net, right? Which means the tenant's reimbursed for everything. Um, we think the real upside is about $4+ a foot over where the rents are now. And depending on the unit size, maybe you get a little bit more lift, whatever. I'll test it at $2 a foot more, which is basically half the rent growth. We say we'll test it at, instead of what we think is going to be 3 month downtime in between tenants, right? 'Cause commercial is different than resi. You have to go, leasing agent, people take tours, whatever. I'll stress it to 6 months. I'll look at, even though we're going to get we're locked now at an interest rate at 6 and an 8, which is really great. I'll run it at 7, right? I'll run the exit capitalization rate, which is really the reversion value of the property. It's a big lever to pull. And if you're wrong on that, it can have wide-ranging implications. Really easy with a flick of a wrist to make a deal look like it works if you get really aggressive on that stuff, right? We'll beat up annual rent growth. I mean, we'll beat the shit out of the deal, for lack of a better way to put it, until it's at a place where you're like, all right, even if hell freezes over, we're still going to get our money back and we're still going to make a 10% IRR, right? We really shoot for upper teens, right? Or 20 and beyond. That's what our investors want. But what you don't want is to lose money. And listen, sometimes that can happen, right? The world over the last couple of years, a lot of deals got kicked, right? And a lot of valuation got hurt. And you learn you're not invincible, right? You talked a little bit about increasing personal risk, right? It's scary, right? Like when you're an entrepreneur, you know it. When you start out, you're entirely exposed. Like there's no one that's going to come in, at least for me personally, there's no one that's going to come in and protect me or give me money or whatever if the world blows up. Like I grew up very average, right? I don't have that safety net. So you're taking big risk, you're getting big rewards, but you need risk management and you need to protect yourself. And as time goes on, your risk tolerance grows, right? Probably as you're young, your risk tolerance goes up and up and up. And at some point you hit like 50 or 60, hopefully you've made a bunch of money. Your risk tolerance actually goes down, right? You hit the other side. But you become more comfortable, right? Like I've had, it's like a tangent, but like I've had buildings burn down. I've had buildings flood, whatever. The first time it happened, I was like my mind, I'm like, oh my God, what am I going to do? I'm personally signed on a loan, right? Where we have this debt service payment of 20 grand a month. I have exactly zero money basically, right? Relative to what what we've built now. And we have to write a check of 20 grand a month for a mortgage for an asset that's burned down that we have no income on. And the insurance company won't pay us because the guy that lit the building on fire, which we found out after, they didn't know who did it at first. So they can't rule out that it's not, self-inflicted for the purpose of fraud, right? So they don't pay out. So now I have a thing that's burned down, it's not generating cash flow, and we're writing these checks, right?
No one got hurt in this process, right?
No, a woman jumped out the window, actually broke her leg, but that was the worst.
Good.
That was the worst. But you had a situation where it was a 6-alarm fire, right? A huge, basically the entire back building of an asset we own burned to the ground, like cinders, not like little fire, like burned to the ground. You wake up in the middle of the night with a video on your phone, right? Someone sends you and you hear people yelling like, get the F out the building. And then the phone pans over and there's just raging flames. And you're like, your mind is blown. You're like, where do I start? Where do I begin? And the point is, the more knocks you take and the more risk you take, the more you become okay with taking additional risk. Risk begets risk, right? Because after you've navigated these really challenging times, you realize like, okay, fine, I've dealt with it. Oh, I have another fire? Big freaking deal. I've had it before. I know how to deal with it. Now let me call in my team. Let me fix this and let's get going, right? And you learn from it and, it's kind of like, you crawl before you run, you run before or you walk before you run, whatever the saying is. As you get more comfortable in your profession and as you get more comfortable with your business, you can learn to take more calculated risks. Like I'm sure, you do it at IPX every day. Now stuff that you take money and you invest in for R&D or you take flyers on because it could become an next piece of your product line. 4 or 5 years ago, you probably wouldn't risk the money on that because you'd say, I have other things right now and I don't know what the outcome's going to be. But now as your company's maturing, right, and you're becoming more successful, you're realizing some of those risks are risks necessary and worth taking because the payoff could be tremendous. And you don't know if you don't take that opportunity, right? But we talk about building networks and we talk about building a team. You asked me before. one of my best GCs that I have down in Charlotte, who's a friend of mine, great human, great family. You know how I found him? I found him the day my building burned down. I had no one to friggin' call. And I literally basically went online and was just calling every single GC with a phone number online saying, hey, I have this really bad problem. We bought this asset, by the way, 45 days before it burned. And that was the first asset we bought in Charlotte. Can you imagine this, right? So I literally just went down the freaking list. He picked up the phone. I later found out years later, he was laughing. He told me he picked up the phone because him and his wife were driving and they got in like an argument and he just didn't want to argue anymore. So he saw a random number came in. So he just picked it up to end the argument. Right. And this is how I get this guy on the phone. And now, we've done millions of dollars of business together, right? He's my go-to guy, but I know in a pinch, I can call because of that relationship. So the world works in funny ways, but I think to summarize it, calculated risk is good risk. Haphazard risk is bad risk, right? You need to know what you're doing and you need to take every step imaginable to insulate yourself. Risk is risk, right? Like you can't get around that. So meaning you can't mitigate everything. If you could, decisions that are a roll of the dice, you would never take, right? And they wouldn't generate those same returns, right? Opacity and risk taking is what drives profitability, right? Getting and having better information than someone and taking calculated risk is how you get ahead. But you need to be okay with it. And I think you learn as time goes on and you have to be okay with that. You're going to get punched in the face. Like it's going to happen, right? We've been kicked a million times.
Yeah.
The real thing is what you do next and how you tackle that.
So you've mentioned the importance of getting the right folks on the bus. That's first and foremost. You've mentioned the importance of hard work. You're a lean team that's just grinding out and producing incredible outcomes. How do you think about like what's the competitive edge for your team? As compared to, for example, other folks in the space also looking to acquire, industrial spaces, et cetera. Like how do you think about unique competitive advantages in the space?
Every good deal starts with, there's an old saying in real estate, you make money when on the buy, right? Meaning if you can buy things well, you already start in a really good place and you're already going to be ahead of other people. Most of what we buy is off market, right? So deal sourcing to us is really important. And we have sourced deals in a lot of unconventional ways over time. And we have this wide web of people that bring us opportunities, right? Kind of like I was telling you about with the deal, and I'm motioning, this way because that's where Howell is, right? That direction. But that came to us through someone we knew and said, hey, I know you guys aren't in this space, but there's a really interesting thing. This guy's gonna let this property go. You should really take a hard look at it because it's in your backyard and there's an opportunity to make money. So deal sourcing is important. But I think more than anything, we're really nimble, right? One of the challenges I've seen with companies that get really big, and it's funny, they admire us because we're simple, right? And we're not overcomplicated. We don't have all these layers of bureaucracy. And I admire them because they've built a really, massive organization and they're huge and they have this mega presence. But I think I like the way we've operated where we keep our overhead low, right? We're sub 10 people as Lucern employees at any given time. But we've done a lot of volume and we've made a lot of money. Why that's great is we don't have to do deals to survive, right? That's one of the competitive edges that we have. Like other people have so much money and so much overhead that their payrolls through the roof, their systems costs are through the roof. So they need to do deals to survive. So rather than just do the great deals and the exceptional deals, they're doing mediocre deals and everything in between because it's important to get those fee streams, property management, acquisition fees, whatever, to keep the lights on.
And the mechanics of that is because as a result of staying lean, the cash flows from the properties themselves are able to just make sure that, your default alive effectively. Is that?
That's exactly right. It keeps the lights on, right? And then the big wins are big wins. But what's nice is it allows us to reward our employees well, right? So, we're moving to like a profit sharing plan this year where, employees are going to get profits of these deals, a certain percentage of each deal, the promote, right? Which is, for non-real estate people, that's the bonus you get when you sell for your overperformance over benchmark, let's say, or what's known as a hurdle. So they're going to start participating in some of that. And it won't be tomorrow, right? Because these deals need to roll off. But the idea is you're now vested in the much like a startup gives, early equity to their key people. we can do this because we don't have a lot of people. So I can put chunks of money in bonus pools. And as these deals start to roll off, deals they've worked on for a few years and been in the trenches and rolled their sleeves up and made decisions, they're going to see the fruits of that labor and they're bought in. And, quite frankly, they deserve it, right? So we can be nimble. Like, someone calls me and say, Frank, I got this deal in Atlanta. You want to take a look at it? I'm like, done, plane ticket, booked. I'm coming down. I'll bring one of our guys. And we can move really quick. What we see with some of these bigger corporations that have a lot of employees, they need to do a lot of deals to survive. So naturally the quality of the deal, comes down because you need to do more and there's no way to get, it's much like any fund manager you see. As their size grows, the performance decreases because it's just not physically possible to do the best of everything with a lot of money, right? And we're nimble. We can move quick. I don't need 10 layers of I am the decision maker. You call me, you have a great deal. I'll have an LOI to you in 10 minutes, right? And we could figure this thing out. So we're able to move quick and we're very agile. And I would be foolish to think we have like some sort of very special competitive. There are a lot of people who are way better at at real estate than we are, right? And there are a lot of people that are way worse. It's an abundance mentality. There's enough property and deals out there for everyone. This isn't like, white shoe private equity, like, you're Carlisle and I'm KKR and we're fighting over the same takeover of some medical company or something. And, it's a win and lose zero sum game. I mean, there's more than enough out there for everyone. And having that mentality is good. So we're far from special in a way, but we're really good at what we do. And we try to reward our employees and keep it small and have everyone to be have a real say in what's going on and a lot of autonomy. And we're agile and we can move quick. And that's led us to be really successful over the years.
I know your team is heads down right now on, a variety of deals, but if you were to kind of, lift your head up, look above the water, what's success look like? Like right now, I know the goal is, grow, expand. 3, 4, 5 years from now, what's the dream? What's success? Is it growing within that specific sector? Is it diversifying? How do you think about that? Perhaps the answer is just, we actually don't know. I mean, with technology changing and trends changing every 6 months, it's getting harder to think about this.
Yeah, well, that's what I was gonna say. To be honest, I would say I don't know, man. Like I really don't. I want to continue to be successful. We want to ride this next leg up, all right, this next cycle up. We just came out of a cycle and sort of bottoming now, and it's about to go up again, right? I want to ride this next sector up. I want to, obviously, naturally at a very base human level, right? Provide for my family, and I have one child, so that's really important to me, and of course my wife. But we don't. I used to think I wanted to get to this crazy level, right? Be worth this crazy, atrocious amount of money, and it would still be great. But now, as the realities of, we have one child who's very healthy, super smart, whatever. She's like our whole world. Like I don't need to get to that level anymore. It's still nice and I'm still gunning for it. Don't get me wrong. I'm not taking my foot off the pedal, but it sort of put into perspective how I shape my decision making with my business, right? Because if I can make a really good living, put away, a lot of money for the future, and our employees can do really well and have satisfaction and have a really nice living. And hopefully when I always hire people, I always say, I hope you're here forever, right? Because, as much as they're employees, they have a very vested interest in what we do here. And as profit sharing and as we grow, we continue to grow deals, like those numbers will build. And, there can be a really significant amount of money. And I think there's something to be said for that. We provide a lot of flexibility. To sum it up, like I don't know, but I want to provide a nice workplace for the people that are here. I worked some really horrible, jobs, not from a sense of personal gratification, but from like terrible people work for, and that old sort of Wall Street culture where you're working 80, 100 hours a week. I worked a lot like that for a long time. You burn out and you begin to resent the people you work for, and I don't want that to happen. I think should be an abundance mentality, and I think I just want to create a place where everyone could do really well, be successful, stay here forever, comfortable, have flexibility, make money, take care of my family, obviously have market presence for sure. And I just want to run a good company. And now part of what I've started to do is, this I try to give back, right, where I can and take young people and give them advice and mentor them and help them along. And now I've begun to take, some of this money that I've made and invest it in other startups and venture stuff and interesting things to help the next generation of people. I'm far from, at a place where like I'm some, $100 million angel investor, but I have the opportunity now to do this. So I'm sort of trying to pay it forward a little bit that way. I'm an advisor to a couple of startups that I believe in, right? Obviously, IPX is one of them. So I'm trying to help other people wherever I can. And I think there's a lot of gratification in that. And yeah, I just want to run a clean shop, do well, make money for our investors, make money for ourselves and our families, and that includes the people that work for us here, and overall be successful. Like if you ask any real estate investor, most of them do this till they're 80, because once you get the itch for a deal, like I'm a deal junkie, right? We all are. Real estate has no age. It's not like playing tennis, right? Where you get tennis elbow at like 60, you can't play anymore, right? I could do real estate forever, and I probably will. I can't. I have way too much energy to stop working. At any defined moment. So yeah, I know it's not a great response, but I think
it's fantastic. I think it's refreshingly practical. I think in a time where folks are, often a little too highfalutin or like kind of worried about changing the world a little too much, but not enough substance. I think your kind of on the ground perspective, very practical, is actually quite refreshing.
Well, that's why I have to help. That's why I have to help people like you change the world.
Well, I think it's a fine balance, right, between obviously thinking big picture, but also not losing sight of what's happening on the ground and the very real challenges and opportunities and the day-to-day challenges of buildings potentially getting on fire. I think that those are some of the day-to-day things that I think we just have to remind ourselves. But I think I'm excited to watch your journey. For folks that want to work with you, follow your journey,
Yeah.
but where should they look? LinkedIn, email, like how do they follow you?
Yeah, sure. Shoot me a note on, shoot me an email, right? My email is frank.forte@lucerncapital.com, lucerncapital.com. You can follow us on LinkedIn. Alternatively, you can go to our website, right, and get in touch with one of us. If you're someone who sells property or has, investment opportunity that you think would be, part and parcel to what sounds like we're doing here, definitely share them, shoot them over. If you're an investor who's interested and you're accredited, you can reach out to us as well. But yeah, that's the easiest way. And we put out a lot of content to help people who are newer to the space and who don't, understand some of the intricacies of it. Some people who are, mature in the space may find the content, boring or very low level. But the idea is to put it out for people who are learning and kind of are starting that journey. So there's a lot of that out there, and I'd encourage you to go on, our website and check it out, and follow us. But yeah, that's the easiest way.
Super fun. Frank, thanks so much.
Thank you so much. Appreciate it.